LOSA described types and categories of alternative investments. And it's hard to define alternative investments. It's easier to define it in terms of what it is not. And alternative investments is anything that's not a traditional investment. So it's anything other than long-only, publicly traded investments in stocks, bonds, and cash. So it could be private investments in stocks and bonds. That would be considered an alternative investment. It could be publicly traded investments in assets that are not stocks and bonds, such as futures in terms of commodities. Or it could be short positions, because this is saying long-only publicly traded investments. So we define alternative investments not by what is included, but what is excluded. What is excluded is long-only publicly traded investments in stocks, bonds, and cash. Those are considered traditional investments. And it's not just assets that fall under the category of an alternative investment. It is also strategies or approaches, such as hedge funds or private equity funds, because you can make an investment into these, and it is alternative investments, not alternative asset classes, alternative investments. And these investments could be in a particular type of alternative investment, a class of alternative investment, or a strategy, and typically involve active management, because when we move to private assets, typically there's much more inefficient pricing, and that means that active management has a great ability to add extra value. Characteristics that we will see as we go through the categories of alternative investments, and we're going to look at, spend some time in each of the different sections: hedge funds, private capital, natural resources, real estate, and infrastructure. So we're going to see aspects of these characteristics in all of them, some of them more so than others, but typically when we talk about alternative investments, these characteristics tend to be present. Narrow specialization of managers. So if we're investing in an infrastructure fund, we want to know that the managers have a lot of expertise with infrastructure, or a lot of expertise with real estate if it's a private real estate fund. Now, we don't really care if they know much about bonds or equities, as long as they really know the domain that they're investing in. Low correlations of returns with traditional investments, and we'll see whether or not this is true. The measured return, the measured correlations are low, but is that a function of it having a low correlation with traditional assets, or because of its return series being measured in a different way that gives it the illusion of lower correlation? So we'll look at that in some of the segments coming up. Limited historical risk and return data. A lot of private funds have limited lives. They're 8 to 10 to 12-year funds, so you're not going to get a lot of data out of some of these investments, because once they're done and wrapped up and return their money to investors, it's over. So you might have better luck following a particular private equity or private real estate manager who has multiple funds as opposed to any one fund. Unique legal and tax considerations. We will see this in real estate. Higher fees, both management fees and performance fees, because if there is active management and managers have very specialized knowledge, you're going to pay for that. Concentrated portfolios, especially with real estate, these are big chunky investments. So a fund doesn't have a portfolio of 50 or 60 different assets that it has. Typically, it'll have a portfolio of 10 to 15. Same with private equity. Maybe 5 to 15 different investments in companies. And restrictions on redemptions. We'll see that when we discuss hedge funds. For private capital firms, there are no redemptions. They're simply just return of capital when the liquidation events happen. But hedge funds, because you can come and go, there are restrictions on when you can ask for your money back. And alternative investments offer, and I put in brackets, potentially, because we'll see whether or not this is true depending on the type of alternative investment we're looking at. They offer potentially broader diversification than a traditional asset portfolio could offer. Enhanced returns, meaning risk-adjusted returns, and we know that risk-adjusted returns is our excess return over the volatility of those returns. Increased income through higher yields. And this is just the difference between public versus private securities. Private securities should offer a higher yield to begin with. Also, the fact that they're illiquid will also have an illiquidity premium on top of the fact that they are private. All right, let's run through the categories of alternative investments very quickly. Just a couple of bullet points behind each one, just sort of to get the flavor of what's coming up, but we spend entire sections on each one of these. So it's not as if I'm shortening what you're going to see. I'm just giving you a very brief introduction so you have a very high-level view. We get into it a little deeper later on. Hedge funds, private investment vehicles. Notice the word here, private. They can use traditional investments, and this is what makes a hedge fund an alternative investment because it is private. This is the key word here. Even though they can use traditional investments. They don't have to, but they can use traditional investments. They are absolute return investments, at least most commonly absolute return investments. The difference between that and a relative return is a relative return will have a benchmark, like the S&P 500 index, S&P 500. So a manager just really has to beat the S&P 500. So if the S&P 500 is down 6% for a year, as long as the manager is down 4%, the manager has done well. That's not acceptable for a hedge fund. A hedge fund typically will have a benchmark of the risk-free rate plus some spread. 300 basis points, let's say, above the risk-free rate. Since the risk-free rate, which is LIBOR, tends to be positive, a positive return plus a spread, even in stress times, will still create an absolute return hurdle that the hedge fund has to meet. So good times, bad times, the hedge fund has to beat that particular benchmark, which is an absolute return benchmark. Private capital, this can encompass private equity and private debt. And private equity can be a direct investment or through a private equity fund. So a direct investment is, take someone like myself, I've got an extra $500,000 lying around. I like a group of guys that are starting a business, and I say, I'll invest directly into your business for 30%. You've seen Dragon's Den. That's direct investment. Or through a private equity fund. So there's a group of managers that are very good at identifying businesses, private businesses to buy. You would invest in their fund, and then they would go out and buy companies. PE funds can invest in private business, or they can invest in public businesses with the intent to take them private. The majority of capital in PE funds is typically involved in leveraged buyouts. This is the public to private, or taking a private company away from the current management, maybe a new management team coming in. Venture capital, also under private equity, invests in startups. This is typically a small portion of the PE market. And then there's private debt. Not much to say here. It's debt provided to private entities. Pretty much what it says, private debt. Real estate, and here you can invest directly or indirectly. Investing directly means an investor with enough capital can step in and buy an apartment building or buy an office complex. The real estate category under alternative investments encompass private commercial real estate equity and debt, and public real estate equity and debt. And public real estate is through REITs. Yes, considered an alternative investment, and debt, mortgage-backed securities. Next, we have natural resources. This encompasses three different categories here: commodities, agricultural land, and timberland. Commodities access can be gained through futures, ETFs, and CTAs, commodity trading advisors. When we get to the natural resource section, we'll expand on that more. Agricultural land, this is farmland, can be leased or crop shared. Leasing means you own the land and you lease it to a ranch or you lease it to a farmer. Crop sharing means you own the land and you have somebody actually cultivating the land for you, and you share in whatever the yield of the land is. Timberland, natural forests or managed tree plantations. Infrastructure, this is capital-intensive, long-lived assets intended for public use, and they provide essential services. Typically purchased by and operated by governments, but more and more there is a lean towards public-private partnerships, PPPs, and that's where the opportunity for investment in infrastructure is. And then others. We don't talk about this in this particular reading. We just sort of mention it here. Tangibles, art, wine, collectibles, intangibles, patents, litigation actions. This requires super specialized knowledge, which is why it's really not covered in this section. This is very niche. LOSB. Describe characteristics of direct investment, co-investment, and fund investment methods for alternative investments. So we have three ways that we can invest in AI. We can invest through a fund. Investor contributes capital to a fund, and the fund makes the investment. So we're basically hiring the expertise. We're hiring the managers, and they'll take care of it. So we're rather passive in all of that. Even though the fund managers may be very, very active, we're sort of just sitting back saying, here's my money. You go ahead and turn it into something more. Involves management and performance fees. Obviously, you're hiring the talent to do it, right? Co-investing. This is an opportunity where an investor in a fund has the right to invest directly in the same assets. So it is part of fund investing, but you also retain the right to do some direct investing, which is now called co-investing. So step one, you must be within a fund. They identify an asset that you think is rather nice. You're invested in the fund. You say, I'd like to sidecar that as well. So you also make a direct investment along with the fund in that particular asset. And direct investing, no intermediary, typically large and more sophisticated investors here because alternative assets tend to come very chunky, very big prices for each of them. So if you're involved in direct investing, you're typically of the much larger investor size. All right, for going through fund investing, co-investing, and direct investing, looking at advantages and disadvantages, there's a great exhibit already in the reading, so I've replicated it here rather than just printing out every line on the screen and doing it that way, because I would just print out every line. Fund investing, fund managers offer investment services and expertise. This is really what you're paying for here is the expertise. Lower level of investor involvement compared with the direct and co-investing methods. Access to alternative investments without possessing a high degree of investment expertise. Potentially, look at the wording, we always keep throwing that, potentially valuable diversification benefits and lower minimum capital requirements. However, if you're getting expertise, you're going to pay for it, right? Costly management and performance fees. And it doesn't eliminate due diligence. If you're investing directly in an asset, you have to do due diligence. If you're indirectly investing through a fund, there's still due diligence. You have to do your due diligence on the fund managers and their level of expertise. The investor must conduct thorough due diligence when selecting the right fund because of the wide dispersion of fund manager returns. Co-investing, investors can learn from the fund's process to become better at direct investing. Reduced management fees, not by being part of the fund, but when you're making a sidecar investment, when you're co-investing alongside the fund, the capital that you put the capital you put directly into the asset won't have the fund's management fees on it. Allows more active management of the portfolio compared with fund investing. Allows for a deeper relationship with the manager. Negatives here, reduced control over the investment selection process. The fund itself will present you with opportunities to invest. It's not as if you can say, hey, this is interesting. Why don't you invest in it so I can invest in it? They pretty much have the deal flow. May be subject to adverse selection bias. And this is a situation where a fund may find a deal that's so good, the returns are going to be so great, they don't offer it for co-investing. They only offer other investments that may have lower returns for co-investing. So it may be subject to adverse selection bias, requires more active involvement compared with fund investing, which can be challenging if resources and due diligence expertise are limited. And direct investing, pretty much you can take all of the disadvantages here and turn them into advantages. Avoids paying ongoing management fees to an external manager. Greatest amount of flexibility for the investor. You get to choose what deals you want. Highest level of control over how the asset is managed. Disadvantages, requires more investment expertise and a higher level of financial sophistication compared with fund investing and co-investing, resulting in higher internal investment costs. Less access to a fund's ready diversification benefits or the fund manager's sourcing network. This is the more critical one. You may decide, look, I'm going to buy real estate directly. Well, you have to have deal flow. You have to have access to all the good assets. And the good assets typically get taken out very quickly by the private funds, sometimes without ever hitting the market, simply because they have a sourcing network where they know that something is going to go up for sale and they'll take care of it, or they'll enter negotiations even before you would even know that it's available. So this is the key one right there, the sourcing network. Requires greatest level of due diligence because of the absence of a fund manager. and higher minimum capital requirements. You can't just put $2 million into a real estate fund and say off you go. If a building is $50 million, it's $50 million. So you have a higher level of capital that's required for a very concentrated position, one asset. You have no diversification at all. And the issue of due diligence, we did mention it on the previous screen, but for each of these, direct investment requires considerable expertise. Fund investing, you need skill in manager selection. And co-investing, you can rely on the due diligence performed by the fund in sourcing the investment. Exhibit 3, we're not going to go through it here, but Exhibit 3 in the reading gives you a long checklist by category of the type of due diligence that you would need to perform. LOSC, describe investment and compensation structures commonly used in alternative investments. Most funds are structured as limited partnerships. So you should be familiar with the terminology here. GP, this is the general partner, typically the fund manager. GPs have unlimited liability. Then you have LPs or limited partners. This is the investor. They have limited liability as long as they do not get involved in day-to-day operations. So as long as they stay limited in the sense of their management of the fund, they have limited liability. But an LP that decides that they're going to be actively involved in the day-to-day operations of the fund would then be considered another GP and also have unlimited liability. The partnership is governed by a limited partnership agreement, an LPA, which may also have something called side letters. And these are agreements between the GP and certain LPs that exist outside the LPA. So the limited partnership agreement may be okay for most investors, but I'm a pension fund, and I look at it and I say, listen, I'm going to need certain things to happen that you're not providing to your other LPs. And if the GP and I agree, we have a side letter. And things that are included in side letters, extra reporting. So I may need an extra level of reporting. First right of refusal for co-investments. And fee matching. That means if another LP comes along that is like me, and you offer them lower fees to bring their money in, you then have to give me those same lower fees. Carrying on with investment structures, when we are dealing with infrastructure, public-private partnerships, we'll have more to say about that later. For real estate funds, they're typically set up as trusts, and investors are referred to as unit holders. If it's direct real estate investing among a consortium of investors, a joint venture structure is used. Compensation, management fees, 1 to 2% of assets under management if we're talking about hedge funds, or of committed capital if we're talking about private equity or any private capital. Performance fee, also called an incentive fee or carried interest, is based on excess return above a hurdle rate. So it might be worded as 20% of return above a hard hurdle rate. So let's say the hurdle rate is 6%. It's anything, 20% of anything over the 6%. If it's worded as 20% of total return, if a soft hurdle rate is met, in other words, if 6% is the soft hurdle rate, then it is 20% of the total return, not just 20% of the return above 6%. So a hard hurdle rate means the first 6% belongs to the investor, then the fund managers get 20% of the excess. A soft hurdle rate means as long as we hit 6% return, the fund managers get 20% of the total return. May also be consulting and monitoring fees for certain types of private equity, such as leveraged buyouts. There are more fees than just the management fee or the performance fee. Typically, general partners do not earn performance fees until the limited partners are made whole. This is very common with private capital, or the hurdle rate is exceeded, which is pretty common with hedge funds. In reference to the incentive fee, there may be something called a catch-up clause. This is typically found in private equity. The best way to explain the catch-up clause is to just show it. So let's say that a fund returns an 18% internal rate of return and had an 8% hurdle rate. The limited partners would get everything, if you have a catch-up clause, the limited partners get everything up to 8%. Then the general partners get everything between 8 and 10%, because if you get to 10%, 20% is 2%, which is right here, which is what the general partners would get. Then anything after that is 80-20. Limited partners get 80%, general partners get 20%, so we have another 8% here. So the GPs, we get another 1.6%. They get 3.6% in total. If there is no catch-up clause, the limited partners get everything up to 8%, then everything after that is split 80-20. General partners get 20% of the excess, so in other words, they get 2%. Another way to think about this is sort of the same thing as a hard hurdle. When we're talking about hedge fund returns, that's the same as a hard hurdle. This would be the same as a soft hurdle. Notice that 3.6% is 20% of 18%, whereas 2% is 20% of just the excess, which is 10%. 2% is 20% of 10%. A high watermark, this is in reference to hedge funds, is the highest value used to calculate an incentive fee. And incentive fees are only available above this level. Why? Well, let's think about the net asset value of a hedge fund. It's going up, and there's your return. Fees are paid. And it goes up and up and up. There's your return. Fees are paid. Now it goes down. Well, fees have already been paid up to this level. So if the hedge fund performs here and hits that return, so you had positive return, negative, followed by positive. Well, that has already been, fees have already been paid on earning that money. You can't lose it, earn it again, and get another fee. Fees would not take place until you breach the high water mark, so you'd have to get up to here, and then funds are only available from the high water mark up to the new net asset value. It is possible that limited partners have different high water marks depending on when they invested. So if I buy into a fund down here, that is my high water mark. So basically, the fund managers that get up to here can take a performance fee off of my part of the investment, but not of anybody else that was in previously that had a different high water mark. That's a lot of accounting to follow per investor. So that's why hedge funds typically have a limited number of investors that they allow. Sometimes hedge funds are just full. That's it. They have a certain number of investors, and you can't buy into that fund unless another one leaves. Distribution methods for private equity follow what's called a waterfall approach. There's a deal by deal and a whole of fund. A deal by deal, also referred to as an American distribution, and whole of fund referred to as a European distribution. And much like the catch-up clause, the best way to explain these is to show them. All right, so we have the same setup under both deal by deal and whole of fund. So let's look at the deal by deal. We have 8 different investments. We have the year that's invested and the year that it's sold, the amount that was invested, the amount that was sold, and the profit. There's 10 million and the percentage, and what the GP would get if it were deal by deal. So assuming GP at 20%, the first investment cost 10 million, sold for 20, so there was a profit of 10 million. And the GPs get $2 million. On the second investment, we have a profit of 15, and the GPs get 3 million. Next, we have a profit of 40, GPs get 8 million. The next one broke even, so nobody gets anything. Then we had a series of losses or negative returns. And at this point, the GPs have to give back 2 million. This is called a clawback, when they have to give back what they earned. Then they have to give back another million. Then they have to give back another 6, then another 4. Notice that the limited partner ends up with 200 million. Same down here on the whole of fund, ends up with 200 million. The difference comes in when the LPs are made whole. The LPs are made whole here on investment number 8 with the final 4 million clawback. Whereas we look at whole of fund, notice the GPs get nothing until the LPs are made whole. Well, they're not made whole until they get all their money back, and they're made whole on deal 6 over here. The next 2 are complete write-offs, so there's nothing involved. So even though they both end with the same amount, 200 million, the LPs are made whole here at investment number 6, whereas the LPs are made whole here at investment number 8. So because and we'll see this later, that we measure the performance of the fund by the internal rate of return, the timing of the cash flows determine what your return is based on IRR. Even though it's the same thing, they end up in the same place, the internal rate of return here for the investor will be higher than the internal rate of return on a deal-by-deal basis. On to LOSD. Now we're going to get into each of the different alternative investment classes that we looked at earlier. We'll start with hedge funds, explain investment characteristics of hedge funds. They are creatively, that's a nice word there, in other words, actively, creatively managed, involved in one or more asset classes and geographic regions. You will see the use of leverage, short positions, and derivatives. The goal is to generate high returns on an absolute or a risk-adjusted basis, and we'll see later on that there are different ratios that we can calculate to determine what the risk-adjusted return is, all with little problems. Very few investment restrictions. Private investment partnership open to a limited number of accredited investors, and they are lightly regulated. In exchange for accepting only accredited investors, they are lightly regulated with few investment restrictions. Mutual funds are heavily regulated, a lot of investment restrictions because they can take anybody's money. But hedge funds can only take accredited investors. They're called sophisticated investors. So regulators say they should know what they're doing. So the hedge fund has a lot more latitude and a lot less regulation. The goal is to generate high returns on an absolute or a risk-adjusted basis, and we'll see later on that there are different ratios that we can calculate to determine what the risk-adjusted return is, all with little problems. Very few investment restrictions. Private investment partnership open to a limited number of accredited investors, and they are lightly regulated. In exchange for accepting only accredited investors, they are lightly regulated with few investment restrictions. Mutual funds are heavily regulated, a lot of investment restrictions because they can take anybody's money. But hedge funds can only take accredited investors. They're called sophisticated investors. So regulators say they should know what they're doing. So the hedge fund has a lot more latitude and a lot less regulation. Minimum investments are required. You can't just say, look, I got $1,000, here you go. Most funds are $5 million and up, $10 million and up. Some are $25 million and up. And there are restrictions on redemptions. You don't give a hedge fund money and 6 months later say, you know what, that's a good return, I'd like my money back. There are typical lockup periods from the time you invest. There are redemption gates, which limit the amount of redemptions that can happen at one period at any one given time, and there are notice periods. And a fund, by the way, if it's not doing well, can suspend redemptions and say, yeah, you can't have your money back at this point. A hard lockup means no redemptions. So there might be a hard lockup for the first year, the first 18 months. It depends on the strategy. The more liquid the strategy is, the shorter the lockup period will be. But if a hedge fund is involved in a lot of illiquid assets, it may have a much longer hard lockup period, like 2 years. A soft lockup, you can get a redemption, but for a fee, basically a penalty, which makes it not worth it. But if you are going to do it, it makes it absolutely worth it for the hedge fund to do it for you. And there are notice periods for redemptions, 30 to 90 days notice of a redemption. And usually they're quarterly. And there are typically redemption gates. The reading doesn't talk about the redemption gate, but what it means is, let's draw a timeline, and let's say there's 2 redemption periods, and you give your notice over here for redemption here, and some other people give notice. Well, the redemption may have a gate of 10%. In other words, no more than 10% of the fund can be redeemed at any one particular time. So if 4 people or 4 investors want out and they represent 20%, they would all have only half of their redemption met. Another avenue for hedge fund investment is to invest in a fund that then invests in hedge funds. They're called fund of funds. They invest in hedge funds. You're getting due diligence expertise. Rather than you doing due diligence on each fund manager, you invest in a fund of funds, and they will do due diligence on all the managers. Still, it just backs up due diligence one point where you have to do due diligence on all the fund of fund managers. With the fund of funds, you also get manager diversification. Because if they're investing in a bunch of different hedge funds, now you have manager diversification, right? They're better able to negotiate redemption or fee terms. But the fund of funds will also have another layer of fees, typically 1% management fee, 10% incentive fee on top of the underlying hedge fund fees. So when we talk about hedge funds, you typically hear the 2 and 20 structure, 2% management fee, 20% incentive fee, and the fund of funds has a 1 and 10 structure. So that sounds like a lot of fees, but nobody really gets those anymore. The big fees have sort of disappeared. It's getting harder and harder to become a billionaire this way. All hedge fund fees have moderated over time. Management fees are typically on average 1.3% for the hedge fund instead of 2%. And the incentive fee on average is 15.5%. For the fund of funds, it's typically 1% flat, or it'll be a 50 basis point management fee plus a 5% incentive fee. Let's look at hedge fund strategies now. Equity hedge. Public equities, long and short positions, derivatives. A bottom-up or a top-down approach can be used. What's a bottom-up? You find good companies and bad companies. Go long the good companies, short the bad companies. A top-down approach is you look at where you are in the business cycle and you say, okay, I want to be in industrials and in tech, and I certainly don't want to be in utilities and let's say banks, whatever it happens to be. So you would then follow sector strategies where you might buy sector ETFs representing the sectors you want to be in and short sector ETFs that you don't want to be in. You can use a quantitative or a fundamental approach. Okay, some sub-strategies under equity hedge. Market neutral. Identify over and undervalued securities. You take long and short positions and you set it up so that you're targeting a beta of 0. Also, you'd like to be neutral on any industry or any particular sector exposure as well. And because you have a beta of 0, you're long and short, you're looking for the divergence between two securities. It will typically use a significant amount of leverage. Fundamental long-short growth. Identify companies expected to exhibit high growth and capital appreciation for your long positions, and you're going to short companies under downward pressure. These funds are typically net long. And fundamental value. Identify undervalued companies or unloved companies to take long positions in. Possibly short overvalued growth, although this is very, very risky and not always a bright thing to do. But possibly you can offset your long positions in these unloved companies with overvalued growth. Typically long biased, beta greater than 0, and the fund will have a strong value tilt and a small cap factor exposure. So if you're familiar with the factor model, a way of looking at returns and how we get returns, you have the market factor. It will have a market factor, it will have a value tilt, and it will have a small cap or a size tilt as well. Next, we have a short biased strategy. Here we're going to look to short overvalued equity with either no or some long exposure, typically achieved through index ETFs. So let's break this down. Overvalued equity. This does not mean we're going to look for stocks that have run up in price recently and we think are due for a pullback. Those are not really short candidates. They're short-term trading opportunities if you have the guts to short momentum, especially growth momentum. What we're looking for are companies with an intrinsic value of 0 that happen to be trading still for a price. That's the type of overvalued equity we're looking for. We're looking for a short candidate, companies with no reason for existence, and we want to go short those. However, we recognize that even garbage will go up if the market is going up. So we want long exposure. We'll go long index ETFs because we're not here to pick stocks or pick winners. We're just betting on the general trend of the market. And we've got some equities that we think are garbage. So if the market is going up strong and these are going up as well, we expect them to go up at a slower rate than the market. We would win. What we do want, what the ultimate goal is for the market to recognize that these stocks are worth 0 and we're short and they go down while the market continues to go up. If the market does drop, we would lose on our long position, but we expect the garbage to drop even faster. So no matter which way the market goes, we would win a little or we would win a lot. Heads I win, tails I win. Kind of makes it a nice trade. Sector specific, here we have manager expertise in a particular sector. So perhaps it's junior mining stocks. A hedge fund manager says, I'm really good at this, or it's pharma, or it's biotech. Next broad grouping of strategies are event-driven. Seek to profit from defined events, typically changes in corporate structure. And if it's changes in corporate structure, clearly it must be a bottom-up approach because you have to identify the stock or the company that's going to have a change in its corporate structure. So security-specific analysis is required here. Merger arbitrage, long the target, short the acquirer. So let's say there's a deal where the target's going to be taken out at $40. Once it's announced, the target will probably get to $39 to $39.25. And this gap will depend on how long it is till the closing, what interest rates are at that particular time, and the probability that the acquirer will actually get the deal done. The more probable it is, the shorter the time frame and the lower interest rates are, the tighter this spread will be. So we're going to try to capture that spread, so we'll go long the target. We short the acquirer because typically in M&A, the acquirer overpays. M&A tends to destroy value over time, so we would short the acquirer on that one. Deal spread narrows as the closing date approaches. Typically use a lot of leverage in these deals, 4 to 5 times leverage. Big risk here, deal may fall through. Distressed or restructuring strategies, looking to invest in securities of companies in or near bankruptcy. So 2 types of strategies that can be used here. The fund can buy the debt at a discount that is expected to have a higher recovery rate. These securities are referred to as money good. Or you buy the debt that is expected to become the new equity of the restructured company. These are referred to as fulcrum securities. Another subtype or sub-strategy here, special situations. This involves the equity of companies restructuring other than mergers and acquisitions or through bankruptcy. This is about as far as it gets. And activist. Take large enough positions to affect change in the company, whether it be divestiture, capital distributions, or a management change. Next, relative value. Seek to profit from pricing discrepancies between related securities. So convertible bond arbitrage, the word to pay attention to here, these are convertible bonds. And we're engaging in arbitrage. So what are we going to do? Arbitrage, buy low, sell high, right? Buy the bond, sell the stock. You're going to buy the bond because it's underpriced. You're going to sell the stock because it's overpriced. Well, which is it? Is the bond underpriced or the stock overpriced? I don't know. Buy low, sell high. Let the market figure it out. Next is fixed income in general. Here, different strategies, long and short trades between 2 issuers. So 2 companies in the same industry with the same credit quality but with different credit spreads. Between 2 issues at different parts of the capital structure. So a senior and a junior issue, perhaps the spreads are not wide enough or the spreads are too wide. Or between different parts of the issuer's yield curve. Again, just differences in spreads based on maturity. Maybe they're too wide or not wide enough. Fixed income in terms of asset-backed securities, mortgage-backed securities, and high yield. Here you'll get a higher coupon, plus you might pick up on some relative mispricing between the securities and the assets that are backing them. Volatility, you can have a long or short market volatility strategy. This is very common with options in the underlying, where the options might be implying a volatility or implied volatility that's too high. So you'd buy the underlying stock and you'd sell a call because the call has a higher implied volatility. Or it could be among different options where the implied volatility between 1 month and another month is different, and you expect volatility either to widen or to narrow. Multi-strategy, this is combinations of any of the strategies above. Next, we have a broad category here, macro and CTA strategy, CTA being commodity trading advisors. So let's start with macro, very top-down approach, hence the name macro, right? To identify economic trends and use all asset classes, long and short. This is fixed income, equity, currencies, commodities. Managed futures, also known as commodity trading advisors, primarily trade futures contracts on commodities. Makes sense, right, if they're called commodity trading advisors. However, they're not limited to just that. It's commodities and beyond, so we can see them trading futures in equities, fixed income, and Forex. Moving on to LOSE, explain investment characteristics of private capital. And with private capital, it breaks down into private equity and private debt. Private capital is funding provided to companies not sourced from public markets. We begin with private equity. Investments in private companies or public companies with the intent to take them private. Different strategies, LBOs or leveraged buyouts, also called management buyouts, MBOs, acquire public companies or established private companies with a significant percentage of the purchase price financed through debt. The target's assets will serve as collateral for the debt, and the target's cash flows are expected to service the debt. An MBO, the current management is involved in the buyout, so they'll take out the existing founders and then they become the owners of the company along with the PE firm. An MBI is a management buy-in. New management is involved in the buyout. Venture capital, investments in private companies with high growth potential, usually very early in the growth stage, typically startups or young companies, and VCs have very active involvement in their portfolio companies. We'll look at the stages of business development and the type of VC funding. We'll look at formative stage, later stage, and mezzanine financing. Within the formative stage, it breaks down into 3 other sub-stages: pre-seed, seed stage, and early stage. Pre-seed stage is really the purview of angel investing. The business is really just at the idea stage. Typically, friends and family are financing it, not VCs. VCs pretty much show up at the seed stage. Funds are used to support product development and marketing efforts. Early stage, company is moving towards operation but is still pre-revenue. In the later stage, the company becomes post-revenue, so now it has sales. It's still pre-IPO. It may even be pre-profit and even pre-positive cash flow, but it is post-revenue. Financing here is to support growth. When the company decides that it wants to go public, it starts working towards going public. It may need some financing to get there. That's called mezzanine financing. It prepares the company to go public. It's called bridge financing. Basically, the term bridge financing is exactly what it means. It provides a bridge from one point in time to the next point in time. So they decide they want to go, if this is a timeline, they decide they want to go public. They set a date for the IPO, but you're still going to need some funding, and the money is used to get them to that date as opposed to something specific like product development or market growth. Equity investments are typically made through convertible preferred shares, and this is done so as not to reprice the common shares. So you have a company and the founders will have common shares. And as VC money comes into the company, if the VCs also get common shares, it reprices the common shares the founders have, and in some jurisdictions that's a taxable event. So rather than reprice the common, a new class of shares called convertible preferred are issued, which has nothing to do with the common. It's a different class of shares, and then those can be convertible into common shares on a liquidity event, but it avoids the possible taxation of unrealized profit from the founder shares. Later stage financing may involve convertible debt. Another PE strategy, growth capital. This is the PE company will take minority stakes in more mature companies to help them expand or restructure operations, enter new markets, or finance major acquisitions. And PE money doesn't go into something unless it knows how it's going to get out. So let's look at some exit strategies. A trade sale, a sale to a strategic buyer. This can be done through an auction process or through private negotiation with particular companies. For the PE firm, you get an immediate cash exit for the fund, a higher valuation from a strategic buyer versus a financial buyer. What's the difference between the two? A financial buyer buys a company for its cash flows. A strategic buyer will do the same thing, but also because of synergies, or there's some strategic value in owning that particular business. Lower costs than an IPO, and also lower levels of disclosure. The disadvantages or the negatives with a trade sale: possible opposition by management. Less attractive to employees because with a trade sale, employees will not realize their stock options. If they have stock options, how do they get value out of the options that they have unless there are some publicly traded shares? Limited number of strategic buyers and lower valuation than an IPO. Another exit strategy is the IPO. This will offer the highest valuation. Typically, you'll have management and staff buy-in. Publicity for the PE firm. I mean, that's important. That also helps provide the PE managers or the PE firm with a source of deal flow. If they're known for being able to bring a lot of companies to IPO, more and more founders will seek them out. And future upside if the PE firm retains any of the shares. Negatives here, high costs, long lead times, high disclosure requirements. There could be lockup periods that require the PE firm to hold shares for a period of time. And since we're really talking about private equity funds, we're really only concerned about the PE firm. There's going to be lockup periods for the founders of these firms and for the employees of these firms. That doesn't concern us because we're talking about an investment in a private equity firm. We're only concerned about what would happen with the fund itself. Potential weak market on IPO. Next, we have a recapitalization. And this is where we decide that, well, we can't really engage in a trade sale or an IPO. The market isn't there, but we can recapitalize the existing firm, which means lever up the portfolio company, pay a dividend to the PE firm. So the target company may have no debt. You'll take on a significant amount of debt, and you'll use the proceeds of that debt to pay a big dividend to the PE firm. Now, it's not really an exit. The PE firm still owns the same percentage of the company it owned before, but you have all this debt sitting in front of their equity position. And then, of course, the cash flows from operations will begin to pay down the debt, and that buys them time to grow or to find another strategic buyer or maybe even an IPO down the road. Not a true exit, still a liquidity event though. A secondary sale, this is just a sale to another PE firm, or in the end, a write-off or a liquidation of the target company. Okay, let's look at private debt. This is debt provided by investors to private entities. Direct lending, typically senior secured, carry higher rates than public debt because it is private and will also have an illiquidity premium on it as well. And many loans that are senior secured will be leveraged loans. So the private debt fund may lend $20 million at 6%, but they will borrow $10 million at 4%, and use $10 million of their own money to get the $20 million loan. So we can see that they have a 50-50 debt equity ratio, a 2-to-1 leverage on their funds. So they're getting 6% on $10 million, and they're getting the spread of between 6 and 4 on the second $10 million. Mezzanine loan, subordinate to senior secured, but senior to equity, often used for leveraged buyouts, recapitalizations, and acquisitions. Higher rate, obviously, than senior secured, and may also have equity kickers. These are great if they have them in there. These are warrants, options, or conversion rights that if the equity or the value of the company rises over a certain amount, they would get to then participate in any increase in equity value above that amount. Venture debt provided to startups or early stage companies, typically convertible, or it would just be straight debt with warrants, again, to participate in any equity upside. Distressed debt, buying the debt of mature companies with financial difficulty that have prospects for a turnaround. And finally, we have just one catch-all category called Other. In here we have collateralized loan obligations. We've seen this in the fixed income series. Private debt that becomes securitized into various tranches of credit quality, and there'll be an equity tranche as well. Something called unitranche debt. This is partially secured debt. It'll rank lower than senior secured, but above senior unsecured. Real estate debt, infrastructure debt, and specialty loans, all under the category of Other. Specialty loans, they give an example of litigation loans. So let's say that there is a company that feels that its patent has been infringed upon. It's going to need a lot of money to launch a civil case against the infringer. Well, there are loans available for that where the payoff to the loan is directly related to the payoff of the litigation. Risk and return for private equity. PE is riskier than public equity because of its very nature, being private, plus it's illiquid, so it should offer a higher return. But is it higher risk-adjusted return? Look, you can always get higher return in the market by using leverage, but you won't get a higher risk-adjusted return because the volatility will scale with the size of your position. So if you have exposure to 100 million of equities and you use leverage to get 500 million of equities, it's still the same volatility. So you haven't changed your risk-adjusted return. Does PE offer, or private equity, offer higher risk-adjusted returns? To answer that question, we have a bit of a problem because the historical data is problematic. We have returns and we have volatility if we're going to measure risk-adjusted returns. So for returns, this is self-report. So it's subject to survivorship bias, which tends to overstate returns. So companies, or funds, I should say, that perform poorly will choose not to report. Funds that lose their capital and show losses will not report. Funds that do really well, they're motivated to report. So you tend to overstate returns. Also, for private equity, you have a lack of market prices. That's the whole idea behind private, right? This leads to an understatement of volatility. If we look at the market price of a stock, it does this all the time. It's always moving around, right? So it may be in an upward trajectory and you could do something like this. However, all the movements around there is volatility. However, for a private market, you don't have the daily movement, so you have a mark-to-model system where that may be the price. 1 month later, that's the price. 1 month later, that's the price, etc., etc., so that you end up with this very smooth trajectory of returns, of measured returns, with very, very low volatility, but only because there's no market action behind the price, just a model. So the prices are marked to model, which tends to understate volatility. So you have overstated returns and understated volatility. It will appear that you have higher risk-adjusted returns, but do you? Or is it just an outcome of the way that you measure things? All right, let's look at some risk and return characteristics of private debt. Remember, it is characterized by being an illiquid investment. It is going to have a higher probability of default than public debt would have. But we do have a private market investment, so there should be some inefficiencies, meaning a greater opportunity for mispricing simply because it's not in the public market. Leads to potential higher return, but with higher risk. Now that may sound like a juvenile statement, and I've made this statement before that different investments will have higher return, but with higher risk when we're talking through alternative investments. But is it higher risk-adjusted returns? Yes, you can always get higher return if you're willing to take on more risk. But does the incremental return you get outweigh the incremental risk that you're taking? If so, you're getting higher risk-adjusted returns. And with alternative investments, that really is the promise, is that you're getting higher risk-adjusted returns. But as we've seen, and as we will see going forward, returns tend to be smooth, which means because they're private market transactions, because they're marked to model and not marked to market, the volatility appears to be lower than what it actually is. So yes, we know it's higher risk, but are we actually measuring that risk appropriately, or are we actually measuring the real risk? That's going to be the question that you should get comfortable with, of having really no answer, because it's still going to be with you when you get to level 3. There's a whole reading on alternative investments there, and we really dive deep into the idea of the returns being smooth, so that volatility is too smooth. It's understated. We talk about ways that we can unsmooth that volatility to test whether or not we are actually getting higher risk-adjusted returns. This is an exhibit from the reading which shows a nice trade-off in risk-return space between the types of debt. Infrastructure debt being the lowest return but the lowest risk. And of course, notice that as we increase the level of risk, we are increasing the level of return. We see senior real estate debt. This is backed by a specific property. Senior direct lending tends to be secured by particular assets. Unitranche debt, you'll recall, is partially secured. Then we get to completely unsecured. Much higher risk, and to have that, to have investors accept this level of risk, there has to be some better upside than just the yield on the debt. So these tend to have some sort of equity participation, whether it be options or warrants attached with it. As far as benefits to a traditional portfolio of stocks and bonds, moderate diversification benefits, correlations of between 0.47 to 0.75. So adding private debt to a portfolio of traditional investments does have a diversification benefit. It's not a very strong diversification benefit. It is moderate, 0.47 to 0.75. Well, I thought I would present you with this exhibit. You're not going to find it in your reading. I've compiled it from a number of other sources. And it takes private capital and it distributes it across the business cycle in terms of where it attracts the most capital and where it finds the most opportunities, hence, of course, attracting the most capital. And I've divided them between growth-oriented strategies versus value-oriented strategies. So at the bottom of a contraction and coming into a recovery, distressed debt obviously does very well. Lots of opportunities there. It attracts a lot of capital. Recapitalizations, remember recapitalizations are a form of exit for a private equity firm where they can't find a sale. Well, this is the conditions under which it couldn't find a sale. The economic conditions are not there. Well, let's just do a recapitalization and pay ourselves a big dividend. Infrastructure, because this is usually within budgets of governments to say, well, listen, to help spur economic growth, let's have a big infrastructure spend, and that coupled with the public-private partnerships, a lot of money is attracted to infrastructure funds there. Mezzanine, when GDP growth is expected to be moderate, not really great, you're not really going to get a lot of the growth-oriented investment, but it's not really that bad, so a lot of the value-oriented investments become harder and harder to come by. This is the purview of LBO, and it tends to attract a lot of capital. If growth is very, very strong, money starts flowing to buy and hold funds, growth buyouts, growth equity, and then, of course, venture capital. And in terms of leverage, the venture capital funds, growth equity, growth buyouts tend to use low to no leverage. Venture capital is pretty much unlevered investment. They'll make an equity investment into a firm and they don't lever that up at all. LBOs use a lot of leverage. Leverage tends to increase, and then as we get further into the value-oriented, it may or may not include leverage. Some of the strategies have numbers in brackets. The first one is the average IRR for that type of fund. The second is the multiple of invested capital. So distressed 11.5 and 1.5, much better than mezzanine at 9.1 and 1.3. But look where the big returns are. You have a growth buyout and growth equity, 13.3 IRR, 1.6 times invested capital, with venture capital 30.4 and 1.7. But remember, VC makes up a very, very small part of the private equity market. It does very well if there's very strong and robust GDP growth. It attracts capital, and there are plenty of investment opportunities. At the bottom of a cycle, if you're a private company looking for a venture capital investment, there's not a lot of money for you because they get very, very cautious at that point. And also, not a lot of capital is flowing into VC funds. It's flowing into some of these other funds. So I thought it would be helpful to have this sort of high-level view of private capital and where it sits or where it does best on the business cycle. On to our next learning objective and our next category, natural resources. Explain investment characteristics of natural resources. And in this section, we'll cover off three broad categories: commodities and raw land used for farming and timber. So we'll look at timberland and farmland. Commodities can be broken into two broad categories, hard and soft. Hard are those that are mined or extracted. We can think of gold, copper, oil, versus soft, those that are grown or cultivated. So any livestock or any plant-based product, that being corn, wheat, soybean, sugar, etc. Timberland, ownership of land and harvesting of trees for lumber. So we have an income and a capital gain component here. The harvesting of the trees will give us our income component. The ownership of the land gives us our capital gain component. For farmland, the income component comes from leasing it or from crop sharing. And of course, the ownership of the land gives us our capital gain component. Characteristics, we'll begin with commodities. Physical standardized products, a pound of copper is a pound of copper no matter what mine you take it out of. The primary return on commodities are capital gains, simply because commodities have no income stream other than just the change in price. Examples of commodities are precious or base metals, gold, silver, platinum, base metals, copper, zinc, aluminum. Energy, agriculture, cash crops, things like cotton or sugar. Each may be divided further by physical location. Natural gas is a good example of a market divided by physical location, only because it doesn't transport very well. And grade or quality. Oil is a good example here. I think there are some 120, 130 different grades of oil in the world, and refineries are set up to refine a specific grade of oil. So it's not as if they can buy any type of oil and out comes all the oil products like gasoline, jet fuel, butane, etc. Each refinery is set up for a particular grade of oil. Commodity indexes exist that help us track the price of a broad group of commodities. They typically use futures prices because they're more transparent than using spot prices. And different indexes, because there aren't just one commodity index, there are multiple, they'll all have different constituents. And within each one, even if they have the same constituents, they may have different weightings to each of the commodities. So investments in the commodity space can be either done physically, which is extremely rare because it comes with a whole bunch of costs. It means that you're actually buying the physical commodity, you're storing it for a while, and then you're going to resell it. That comes with a lot of costs in terms of storage and transportation. So it's really reserved for those entities that are already in the physical game to begin with, or through ETFs and futures, which is the primary investment vehicle for commodities. When the futures price is greater than the spot price, the futures curve will be upward sloping. That is called a condition of contango. So we look at the futures curve here, longer and longer dated futures contracts. The curve is upward sloping. For backwardation, as we get longer and longer contracts, the curve is downward sloping, which means the further out you go, the lower the futures price happens to be. That is a condition of backwardation. Some ETFs try to avoid contango markets because you have to roll your futures contracts over every single month to continually track the spot market. Well, you're rolling over your contracts every month at higher and higher prices, and if there is convergence to the spot price, there is negative roll yield, whereas with backwardation, you have positive roll yield. This was covered in the derivatives reading when we talked about the idea of the convenience yield. Timberland and farmland. Timberland income stream is based on the sale of trees and wood, the income stream, not the capital gain, but the income stream on trees and wood. Timberland is referred to as both a factory and a warehouse. It's a factory in the sense that trees grow every year, about 5% a year. So if you don't like the price of timber in any particular year, you can just leave it there. You could just say, we're not going to harvest anything. It's not as if it goes away. The next year, those trees are 5% bigger, so you'll yield 5% more. That's why it's also referred to as a warehouse. So you have a return from growth, the growth of the trees, the return from the commodity price, because the price can go up or down, and capital gains in terms of the value of the land that you happen to be sitting on. Farmland encompasses row crops and permanent crops. Row crops, corn. You grow corn, you harvest it. You grow corn, you harvest it. So every year you cut down your whole field and then you replant it. Permanent crops are orchards. So you have pear trees, peach trees, orange trees, things like nuts and fruit. Must be harvested regardless of price. So it is not a warehouse. It's not as if you could say, well, let's just leave the trees standing for another year and we'll pick the apples next year. Nope, they'll fall. And then come the deer. The deer will eat it all up. So if you want to hunt deer, great. Give them all the apples. But either you harvest it or it just rots right there. So your return from farmland are from the quantities, the yield that you get per acreage, the price of the commodity, and the land for the capital gain component. There is an interplay between quantity and price. The higher the yield is per year on any one farmland commodity, the lower the price will be. It's called a bumper harvest. So if you have extremely high yielding acreage, you tend to have lower prices. However, if there is inclement weather, or negative growing conditions, your yields will drop significantly. And if yields drop in enough places, that puts upward pressure on price. Let's look at risk and return characteristics. For commodities, your return is basically your price return. It does offer portfolio diversification, and there is an element of inflation protection. However, you're getting all of that with a high level of volatility. The price, because all you're getting is price return, so you have to be concerned about the price. Price is affected by supply and demand conditions, and each commodity has its own drivers of supply and demand, so it's far too numerous to get into here because each commodity will be affected by different things. Supply moves in long cycles, what are called 30-year super cycles. And I'll try to draw one out for you here. Let's just draw a good long super cycle. There's 15 years and 15. So it takes 15 years here and 15 here, where there is demand is greater than supply. So you have investment in productive capacity. Well, it takes, for a copper mine, for example, it takes anywhere from 5 to 7 years to bring a copper mine online from the time you start. So it's a long investment cycle. So when demand is greater than supply for a period of time, you have a whole bunch of capital investment in capacity. Well, when that capacity comes online, you tend to have supply increases that tend to last for a long time and outweigh demand because a whole bunch of supply comes online until demand grows into it, and then suddenly you start going down in terms of the supply and demand imbalance, and now you end up with demand outweighing supply, and you enter your next big long super cycle. There is a sort of thinking that we ended our last big super cycle in 2007, 2008 in terms of capacity investment. And then 15 years, if you measure 15 years after that, would take us somewhere around 2022 in terms of supply being greater than demand, which means that we should be, from where we're sitting now, entering the next big part of the super cycle, the next 15-year bull market in commodities. So there's a lot of thinking that in mid-2021, we're somewhere between the end of the bear market in commodities and the beginning of a long bull market in commodities. One last point. Demand changes much faster than supply, which is why producers want to see demand greater than supply for a sustained period of time before they commit to any capex. And because demand changes faster than supply, that's where you get this volatility. Timber and farmland, you get price appreciation from the land, plus you get the yield from whatever the land produces. Risks here, weather, especially for farmland. The growing season really matters. Climate. Climate is not just weather. Weather is what happens from day to day. Climate is the general trend in weather patterns over longer periods of time. We are seeing more and more forest fires than ever before. So that is a risk to timberland. And of course, global supply. The greater global supply is, the more that countries are sacrificing their forests for farmland, the more price risk you have in the commodity itself. Diversification benefits for commodities, as we've already mentioned, there is a hedge against inflation and a low correlation with other asset classes. So adding commodities to a portfolio of traditional assets, stocks, bonds, cash, does have diversification benefits. Timberland and farmland, there is low to no correlation with stocks and bonds, and it does add an ESG component to a portfolio. So let's take an oil company, for example, that needs carbon offsets. It can always buy timberland because forests are a carbon sink. They pull carbon dioxide out of the atmosphere. So they can offset the carbon that they produce by buying timberland, which then sucks up the carbon. And then they have another source of yield, which is the harvesting of the trees. And as long as the trees aren't harvested to be burnt, that carbon will always be captured. So every house that you see that's built with a whole bunch of wood is environmentally friendly right away because it is a carbon sink. It has taken carbon dioxide out of the air and it's simply trapped there, well, until it burns down. All right, let's look at the different instruments that can be used to gain exposure. For commodities, derivatives, the most popular one, forwards, futures, options, swaps. There are exchange-traded products, whether they be exchange-traded funds or ETNs, exchange-traded notes. The ETF will either hold futures contracts or the physical commodity itself. So an example is GLD, which is an ETF that tracks gold. It owns physical gold, whereas a futures-based ETF would be the USO, United States Oil, which trades futures contracts. Some ETFs will use leverage to return 2 to 3 times the underlying's return, maybe long or short. Managed futures, and that's exactly what it is. It's just a fund that manages futures contracts for you so that you don't have to invest in the futures contracts yourself. Not that you're investing in futures contracts, but you're holding either long or short position in futures contracts. Managed futures will do that for you. And then there are some specialized funds, private energy partnerships, note the word private here, energy mutual funds as well. Timberland and farmland, there are investment funds. These are publicly traded REITs. Some REITs will own timberland and farmland, so you can gain exposure through a public equity vehicle that has these as the underlying, or through private funds. LOSG, the big one here, real estate, the one that more and more people seem to be interested in. Explain investment characteristics of real estate. And here we'll make a distinction between two broad types, owner-occupied versus commercial. Owner-occupied is residential housing. And depending on the country that you're in, anywhere from 50% to 80% of the population have exposure to real estate in the sense that they own the house that they live in, or they have an equity stake in the house that they live in. If they have a mortgage, they have some equity attached to it. That's not really the focus when we talk about alternative investments in real estate. The focus is commercial real estate. And commercial real estate is rental properties leased to tenants, including residential. So you buying a house to live in is owner-occupied. It's still a personal investment in real estate. You still have exposure to real estate in terms of what exposure you have in the future as far as planning for your retirement. The equity you have in your house is part of your financial net worth. However, if you buy a house to purely just rent out, that's commercial real estate. Even if it is residential, it's not owner-occupied at that point. It is basically any income-producing property that you buy would be classified as commercial real estate. Investments can be direct or indirect, and it can be in the form of equity or in the form of debt. Some investment characteristics of real estate: you achieve bond-like long-term income and equity-like capital gains, which is what makes real estate so attractive to so many people, is you get a little bit of both worlds in there. You get the nice income stream that you would expect from a fixed income security. However, you do have upside in the property price appreciating over time. Low correlation with other asset classes, and we have an inflation hedge. It's sort of a double inflation hedge. If your leases are set up with escalators tied to the CPI, your income should grow with the level of inflation, plus your property value will also increase with the level of inflation. Direct investing requires large capital investments. You're dealing with illiquid markets. Real estate is very location sensitive. If you're buying a mall and you just happen to be one block off the main road, it's the difference between a high level of rent and low levels of rent. High transaction costs, low diversification. Many direct investors can't really afford to build a diversified portfolio of properties. Professional property management is going to be required, and specialized expertise by area. If you're buying office buildings, apartment buildings, warehouses, all of these require different levels of expertise and knowledge about the real estate market. Let's look at some basic forms of real estate investment. Here we have debt and equity crossed by private and public. So you have private debt in real estate, mortgages, construction lending, mezzanine debt. We've already seen that. In the public markets, mortgage-backed securities. You've seen that in fixed income. Collateralized mortgage obligations, CMOs. There are mortgage REITs, MREITs. Good one is AGNC. I like that one myself. ETFs that own securitized mortgage debt. For equity, direct ownership of real estate. Ownership through sole ownership, joint ventures, separate accounts, or real estate limited partnerships. Indirect ownership by real estate funds or by private REITs. And for public equity, the big one is REITs, shares in real estate operating and development corporations. These are called REOCs, R-E-O-C, listed REIT shares, mutual funds, index funds, and ETFs. All right, let's look at some of the different investment methods we have available. Direct real estate investing. So you're purchasing a property directly or you're making a direct loan. Each can be levered. So if you're buying a property, you might only need 25% down. You'll get a mortgage for the other 75%. Making a loan, you may make a loan of, let's say, $1 million by putting up $500,000 of your own funds and borrowing $500,000 at, let's say, 4%. But the loan you're making is going to be 6%. So you're making 6% on the 5 and you're making the spread on the other 5. Benefits, you have control over the type of tenants that you have, the length and the terms of the leases that you make, when you want to sell the property, what you want to buy, and the level of CapEx. Also taxes. You'll have a depreciation and an interest tax shield. So it is possible for a property to be cash flow positive but taxable income negative, so that you don't pay tax on the particular property, tax on the income that the property generates for a number of years until the depreciation shield starts to decrease and the interest tax shield starts to decrease, so you can defer that cash outflow on taxes for a number of years. Negatives, property management, and that's expensive. Large capital investments are required. You're not going to get a lot of diversification because it takes a lot of money to build a diversified direct real estate or direct investment real estate portfolio. And you're going to need expertise in the markets that you're buying, the types of property and the locations. Indirect real estate investing is done through pooled investment vehicles, whether they be public or private. So a limited liability partnership is a good example of a private investment vehicle. Public mutual funds, REITs, and REITs can be equity REITs, which own property directly, or mortgage REITs, which invest in mortgages. They're shortened to M-REITs, or ETFs. Mortgages. I think we're familiar with what a mortgage is. We've seen a lot of this in the fixed income section. Loans against property. They can be fixed rate or floating rate, fully or partially amortizing on residential or commercial. When we say residential, we're talking about family homes. Again, still commercial real estate because we're renting them out, or you're investing in them for the income stream, but it's still a residential property, even though it's a commercial residential property. Commercial is specifically a commercial building which won't have any residences within them. Private or public in terms of the mortgage, public being mortgage-backed securities. Private fund investing styles. Here we'll look at 3 broad categories: infinite life open-ended funds, core plus strategies, and finite life closed-end funds. The big difference between the first and the third one, since this is finite life, it involves the liquidation of all the assets, involves the selling of the real estate asset, whereas with infinite life, it may at some point sell some assets to buy other assets, but the strategy itself does not involve the liquidation of all the assets as the fund wraps up because it's infinite life. It's open-ended, so investors can enter and exit at any time, and these funds offer exposure to core real estate, core being well-leased, high quality in core cities. Stable returns, primarily from income. You can augment that with a core plus strategy, which means there would be some investment in non-core markets, or the whole fund could just be core plus. Non-core markets, secondary or tertiary cities, or properties with slightly higher leasing risk like hotels, nursing homes, even B malls. B malls, C malls, strip malls. In every city that you're in, there's a number of malls. There'll usually be 1 or 2 malls that are the big dominant malls in the region. All the big name anchors happen to be there. All the national brands are in there. And then you have other malls where some of the names are not national brands. They may be just regional or just local. Those would be called B malls. Those are secondary. And then when you get all the way into your strip malls, those are tertiary properties. Finite life closed-end funds. So you cannot enter and exit at any time since they're closed-end funds. They don't take in new investors. Once they have the number of investors they need, that's it. and it's a finite life, which means they'll buy properties, they'll do something to the property to add value, then they'll sell the property. So there's value added and opportunistic. Require modest redevelopment, upgrades, or repositioning. This is big in apartment buildings where you'll buy an apartment building and then you will remodel each of the units. Typically remodeling is anywhere from $10,000 to $15,000 to remodel a unit. But the IRR from those remodeled units, the incremental investment that you're making, is 18 to 25%, which is super high. And most apartment buildings over the course of the year will have somewhere between 25 to 30% turnover. So if you buy one of these properties, within 3 or 4 years, you can completely remodel all of the units, and you're generating much higher operating income than you can sell it at that time. That's modest redevelopment or upgrades. Opportunistic is a development from the ground up or major redevelopment. So a decommissioned school or a decommissioned hospital will be sold to a developer who will then transform them into condo developments. And again, involves the selling of the real estate asset. It is finite life, typically 10 years. They'll buy a bunch of properties, upgrade them, develop them, reposition them, and then sell them. REITs, these are real estate investment trusts, eliminates double corporate taxation as long as the REIT distributes 90 to 100% of its taxable rental income. Notice it's not its reportable income, it's its taxable rental income. May also require 75% or more of the income to be produced by real estate assets, whether that be property or debt, or 75% or more of its net income to come from real estate assets. When we say that it eliminates double corporate taxation, corporations that have profits pay taxes, and then they pay dividends, and then the investors who receive those dividends pay taxes on those dividends. The REIT itself can avoid any corporate tax as long as it has a distribution somewhere above 90%, 90 to 100% of its taxable income. If it distributes that to its unit holders, the corporation itself incurs no tax, so it avoids that double taxation. Investors gain liquidity because REIT shares are publicly traded, lower trading costs, and better transparency. Because they're publicly traded, every quarter you're going to have financials. You can see how well that company is doing. Characteristics of different types of real estate, residential property. And we're mentioning residential property because the majority of people have exposure to residential real estate. It's owner-occupied. It still is an investment while you're living in it. Over a period of time, it will appreciate at the very least with the rate of inflation. Typically leveraged equity position. That means for owner-occupied, you can put as little as 10% down on a house and get a mortgage for the other 90%. Commercial real estate, suitable for investors with long investment horizons and low liquidity needs because you're not going to sell that property very quickly, and there is big commissions and land transfer taxes with selling properties. Requires day-to-day active management. Debt is typically limited to a maximum loan to value. For owner-occupied, you can get as high as 90% of the value of the property financed. With commercial property, it's significantly lower. Maximum loan to value ratio is typically around 75%, may even be lower depending on the property. The maximum loan to value may be 60% or even 50%. And the property cash flows are critical to service the debt. For owner-occupied, it's the level of your income, which is a form of cash flow. It's not the cash flow of the property, it's the cash flow of the people that are party to the mortgage. For the commercial building, it is the cash flow that the building can generate that dictates the level of debt that it can service. REITs, M-REITs, invest in mortgage securities. Equity REITs invest in properties. And number 4 for the previous section, MBS. We covered this in fixed income. I don't think we need to say anything more here. Risk and return characteristics. To measure the performance of real estate, we need to compare it against something. So we're going to look for real estate indexes. And we're going to see that we can find indexes for public and for private real estate investments, but the private ones have some significant problems. Listed REIT indexes are available. They're basically like any other equity index, and they're also investable. So if we are a REIT investor, we can take a passive approach and invest in an ETF that tracks a particular REIT index, or we can build a REIT portfolio of our own And to determine the success of our investment campaign, we can compare it against a REIT benchmark. If we're underperforming the REIT benchmark, being the index, we would have been better off with a passive investment. So we have to have some way of measuring our return. Private investment performance, in terms of measuring that, can be based either on the fund itself that invests in real estate, or we can just ignore the idea of funds and just look at the performance of underlying properties. Private indexes are not investable. So there is no passive approach to this. So you're either investing in a fund or you're making direct investments in underlying properties. If we're looking at a property-based index, most property-based indexes are appraisal-based. And because they're appraisal-based, you're not going to have this kind of market fluctuation going on. You tend to have a much smoother line because appraisals don't fluctuate from day to day. If you value a building at $10 million and I call you back tomorrow and I say, what's it worth today? You'll probably just say, $10 million. I told you yesterday. If I call you back in a month, you'll say, look, it's $10 million. I just did it 30 days ago. It would take several quarters for you to say, well, I think market conditions have changed. Its value has increased or decreased. So it tends to smooth out volatility, which understates the amount of volatility. If we're basing an index based on funds, fund indexes rely on self-report. We've already mentioned this earlier, so you do have sample selection bias. Here, it would tend to overstate the results. Something a little bit more objective, we can look for a repeat sales index, and this just looks at properties that have sold in a particular period. So let's say 10 properties sold this period. We can go back in time to determine when they were originally purchased from the owner that just sold them. We could look at what was paid for them, and let's say it was 2010, it was bought for $10 million, 2020, it was sold for $20 million. We can determine what a geometric mean return would be over those 10 years. So it's based on just saying, well, okay, of what sold today, based on when they were purchased, what has been the average return on these properties? So it is transaction-based. It is more reliable the greater number of sales per period. However, sold properties may not be representative of the entire market, which is a form of sample selection bias. However, it does give us a more objective number than appraisal-based. Let's look at some risks to real estate. Interest rate risk, especially if you have floating rate mortgages, which most commercial mortgages are. Economic conditions will dictate how leased up your property can be and the lease rates you can get. Operating risk, of course, are your input costs to operating a property. And you have financial risk in terms of leverage. Leverage is good on the way up, but it's just as terrible on the way down. And also securing debt. Diversification benefits, roughly about 50% of returns. If we're talking about private core real estate or listed public real estate, about 50% of returns are derived from income. Real estate has moderate correlations with equities and bonds, so there is some diversification benefit. But a question still remains in terms of volatility. Let's take a publicly traded real estate portfolio, and from day to day, you're going to see something like this. Whereas if we take the same portfolio, the same assets, and we just said, well, they're not public, which means there's no daily price discovery, they're private, they would look more like this. So the question is, does public real estate overstate volatility? Is that just too much? Just because it can be traded, do values really change that much every day on property? Or does private real estate understate volatility? This is a question you're going to see again at level 3. When we go into alternative investments and talk about real estate and we try to pull this apart. So what we do is we say, well, maybe that is too much and maybe that is too little. So rather than do anything with this, let's take this and unsmooth this and see what this would look like if it were unsmooth. And you'll introduce a little bit more volatility into that, and we decide whether or not that makes more sense. LOSH, explain investment characteristics of infrastructure. So what is infrastructure? These are assets intended for public use, mostly financed, owned, and operated by governments. However, a growing share is being financed privately through what is called public-private partnerships, PPPs. That's where the investment opportunity in infrastructure lies. Investments in infrastructure assets can generate returns in a number of ways. Can lease the assets back to the government. This can happen two ways: develop the asset and lease it to the government, or the government could have sold it to an infrastructure fund that then leases it back to the government, called a sale and lease back. Sell the asset to the government, so develop it. Once it's done, sell it to the government, or basically hold and operate the asset. Let's look at some investment characteristics. Stable long-term cash flows, inelastic demand for the most part, and it tends to adjust for inflation. The cash flows would tend to adjust for inflation. Significant capital investment is required. Most of these assets are monopolistic, meaning that only one of it will be built, and highly regulated. These two together combine to create high barriers to entry. So it's not as if, hey, listen, here's a river. There's going to be a whole bunch of bridges over this river. There typically is only one. Or listen, there's some extra land, let's build a toll highway. Well, that is getting something like that done is highly regulated, and it's not just anybody that can build one. Because you have these high barriers to entry, that's what creates these stable long-term cash flows. Long operational lives, strategically important assets, highly leveraged financial structures. And it is the combination of these high barriers to entry protecting these cash flows and these cash flows that do adjust for inflation that allow for a highly leveraged financial structure. And very well-defined risks. You pretty much know what they are going in. Some of them are operational. For most assets, you'll have some operational risk. And some of them are economic, especially when it's like a toll road. The busier the highway happens to be, the more revenue is generated. Categories of infrastructure assets. There is a social category directed towards human activity, education, so building of schools, healthcare for hospitals, social housing, correction facilities. Income here is derived from lease payments called availability payments. It's based on the ability of the asset to provide the service. So if an asset was built and there was some component of it that failed during operation, and there was some part of the asset itself that was not available for use, then the lease payment would reflect that. That's why it's called an availability payment. The other category of infrastructure assets are economic assets: transportation, ICT, and utility and energy assets. We've all used transportation assets to some degree in our lives: roads, bridges, tunnels, airports, seaports, rail. Income is based on usage, so the more vibrant the economy is, the higher the usage, tolls, fees, and charges, so the higher the cash flow will be from that particular asset. So there is some element of market risk associated with transportation assets. ICT assets stores, broadcasts, and transmits information or data. We could think of telecom towers and data centers, and there are REITs that do own telecom towers and data centers. Utility and energy assets generate and transmit power and potable water, because of course we're talking about utilities. Also included in this category: solar, wind, waste-to-energy facilities. Infrastructure assets can also be classified by their stage of development. We have greenfield investments. This is right from the very beginning. So there's just a big field and we say we want this kind of facility there. Needs to be developed. It can be built to sell, build to lease, or build to operate. So you're going to have strategic investors because you're going to need the expertise, and you're going to need financial investors to add the capital along with the strategic investors. Brownfield investments will involve existing infrastructure assets. It could have been an asset that has been privatized by a government and sold to a fund. It could be a sale from a government and an associated leaseback. And the leaseback will have a rate of return, an IRR, that makes it worth it for the fund to do. However, since you have basically a government guarantee sitting behind the lease payments, it will be lower yield, lower risk, lower yield. Could be a sale from a greenfield project. So the greenfield project could have built the asset to sell, and the brownfield investment is buying the existing asset to operate. Here you'll have a mix of financial or strategic investors. The financial investors do not find it necessary to have strategic investors involved. Not the case for greenfield investment because of the skill necessary to develop the asset. Forms of investment, we've seen this in other alternative investment assets. You can either have a direct investment or indirect. Direct in this category, very tough to do, usually the purview of sovereign wealth funds or very, very big endowments. It provides a level of control, but you need very large capital investments. You're going to have concentration risk and liquidity risk. So this is really for investors with extremely long time horizons, perpetual time horizons with a very, very low level or very low need for liquidity. Indirect investment through infrastructure funds, ETFs, or company shares can be done through equity or through debt, with equity participation being the largest. About 3/4 of the capital flowing in infrastructure assets does so with equity exposure. Publicly traded infrastructure securities exist, and there are master limited partnerships on the private side. For diversification, it does add a nice stream of income and some growth potential to the asset, some inflation protection, and a low exposure to GDP growth issues. All right, to sort of wrap up this section, this is a nice exhibit from the reading which breaks down infrastructure assets into high risk profile, medium risk profile, and lower risk profile. And it gives you sort of the target equity returns that you would expect with each of the different categories. So we'll move from lower risk to higher risk. Brownfield assets with mitigated risks, mitigated meaning fully constructed with contracted or regulated revenues, located in the most stable OECD countries, a high weighting to the current yield. So minimal capital appreciation here. It's mostly for those very, very stable cash flows. Target equity returns 6 to 8%. Moving up into medium risk, mostly brownfield assets with some CapEx requirements, and some greenfield assets with limited construction or demand risk. So that you pretty much have a ready customer for the asset once it's built. Located primarily in OECD countries, a mix of yield and capital appreciation. Target returns 10 to 12%. And the highest risk ones would be the ones, obviously, with the most construction and demand risk, ones that need to be built from the ground up with uncertain demand. Greenfield projects without guarantees of demand upon completion. For example, utilities that will have variable electricity pricing, uncertain traffic on roads and through ports, located in OECD countries and emerging markets, a high weighting to capital appreciation. Well, that makes sense, right? If you're not going to have the promise or the security of stable cash flows, there has to be some return component, and that has to come through capital appreciation. Target equity returns 14% plus. It makes sense. You're going from low risk to high risk. You should see your returns have to increase to offset the higher risk that you're taking. All right, LOSI. Describe issues in performance appraisal of alternative investments. And whenever you have any kind of active investment, you have to appraise the performance of that investment. If you're taking a passive investment, it's easy to appraise the performance. The passive investment will return what it returns, whether it be an ETF or an investment in an index fund that tracks an index. That is what you're getting. You don't need to appraise the performance of the fund. There was no active decisions being made. So alternative investments are generally actively managed, although there are some passive choices. And because they're actively managed, we have to have some way to assess performance. And this LOS is to discuss issues in performance appraisals, not necessarily discuss performance appraisal. So we're going to talk about measures that we can use to assess performance, but we're really going to focus on, well, what are the issues with using those measures? A Sharpe ratio is a good measure of performance. It's a risk-adjusted measure of performance. Requires normally distributed returns. If you don't have normally distributed returns, the Sharpe ratio is not a good measure. Return profiles for alternative investments tend to be asymmetric and skewed, so standard deviation is not a good measure of dispersion. And you'll recall the Sharpe ratio is the return on the portfolio minus the risk-free rate over the standard deviation of the portfolio. So if the portfolio is just the portfolio of our alternative investment assets, and this is just the volatility of those particular assets, because it requires a normal distribution, this is not going to be a good measure if we don't have a normal distribution. Therefore, Sharpe ratio is not a good measure of risk-adjusted return. So regardless of the shortcomings of the Sharpe ratio and standard deviation not being a suitable measure, it's still used, and ratios of 1 to 2 are targeted. If the ratio is higher, it's a signal of significant volatility smoothing, because remember, the denominator is the volatility of the alternative asset investment program. So if the ratio is a little too high, it may signify a problem with the denominator. You can get volatility smoothing by using model-based pricing instead of market-based pricing, or if you have a short option strategy, that acts as a hedge and also generates revenue. So you can increase your returns and reduce the volatility by using short option strategies. A Sortino ratio is a modification of the Sharpe ratio. It is the excess return in the numerator, but it's relative only to downside volatility instead of to complete volatility on both sides. Both the Sharpe ratio and Sortino ratio do not consider the correlation of the alternative investment program with the rest of the portfolio. So it could be that it doesn't generate higher risk-adjusted returns. However, because the correlation with the rest of the portfolio may be low, that it provides diversification benefits to the portfolio and improves the risk-return measure for the entire portfolio. So it may improve the risk-return relationship in a portfolio context, or not. Trainer ratio. This is the measure of excess average return relative to its beta to a relevant benchmark. And of course, the lower the beta, the higher the trainer ratio will be. Problem with using the trainer ratio is beta is historical and may be different on a going forward basis. Two more ratios to look at that are related, the Kalmar ratio and the MAR ratio. And MAR stands for Managed Account Reports Ratio, MAR. These are also commonly referred to as gain to pain ratios, because your numerator is your gain and the denominator measures the amount of pain you had to suffer, the maximum drawdown. So if you ever heard the term the gain to pain ratio, it's either the CalMAR or the MAR ratio. CalMAR ratio is the average annual compounded return over 3 years. So when we see an average compounded return, we know that's a geometric mean return over 3 years. So it's an annual return based on a 3-year history divided by the maximum drawdown. And the maximum drawdown is the amount of loss from the peak to the trough. So as the net asset value of the fund is increasing, and then it decreases before it starts increasing, you measure net asset value here to here. That is maximum drawdown, whatever the maximum happened to be. The MAR ratio is the average compounded return using a full history, not just 3 years, and it's the average drawdown, not just the maximum drawdown. Let's move on to PE and real estate performance evaluations. Here we're looking at private funds. This is a little bit different. We can't just use ratios simply because the timing of cash flows are very different. And your return is going to depend very highly on the timing of cash flows. So these are limited life funds, and there'll be some commitment, and we'll just write the word commitment here, that you make for a particular fund. And over time, there'll be capital calls where your money is called down. So you don't just invest all of your money on day one. You commit to invest, let's say, 20 million, and over a period of 12 to 18 months, your capital is called down. The fund may say, okay, we need 5 of that 20 million now. 3 or 4 months later, well, we have another deal, we need another 12 of that, etc. So it's called down and it's put into investments. And these investments begin to increase in value over time. They're marked to model returns, but you'll have increases in net asset value over time until you have liquidity events. And this may be year 6, year 7, year 8, as you get to the end of the 10-year life of most partnerships. There'll be these liquidity events that then crystallize these returns until all the money has been settled and the fund is done. You'll know exactly what the entire return was. Since the capital calls, the investments, and the liquidity events are purely under the control of the fund manager, and we have funds with all differing cash flows, internal rate of return is the appropriate measure to use. And you'll recall that IRR is a money-weighted rate of return, and we would use a money-weighted rate of return when the inflows and outflows are under the control of the manager. So the measurement of success depends far more on the timing and the magnitude of cash flows in and out of the investment. So we're going to use IRR as a key metric, since the timing of cash flows are a key part of the investment decision and they're under the direct control of the fund manager. Another evaluation metric is MOIC, a multiple of invested capital. We did see this a little earlier. I introduced it a little earlier around screen 21, 22, when we looked at private capital, the distribution of different private capital funds over the business cycle. I showed an average IRR and the average multiple of invested capital for a certain number of strategies. How we get the multiple of invested capital is our numerator is all of the distributions we've made to the limited partners plus whatever net asset value is left in the fund divided by the total paid in capital. You'll notice, of course, that this ignores the timing of cash flows. In looking at private equity and real estate, we tend to downplay, in the short term at least, we downplay the correlation of the strategy with the rest of the portfolio, only because on the previous screen, when we saw the return series, we have this effect here called a J-curve, where we're going to have what would appear to be losses for a period of time or drops in net asset value before we hit break even and actually start to show returns, more positive returns, as the target companies gain in value and overcome the fee drag. So less emphasis is placed on correlation benefits over shorter periods. Net asset value may not reflect short-term changes in value, thus understating volatility. Remember, I said as we draw down capital and invest in the target assets, whether they be real estate assets or private companies, it takes a while for these companies to start earning value, and they're marked to model. So the net asset value of the target assets increases over time, steadily increases over time, with very little variation in price. So you don't have a lot of this going on. that you would have if it were more market driven in terms of pricing. It appears to deliver smooth returns over time, thus making private equity and real estate funds appear less correlated than they actually are. And because of that, the correlation metric in terms of its benefit, its diversification benefits, is downplayed in the short term, only because it's just not a very good measure. Other performance measures that are more valuable: quartile ranking. And this can be done based on IRR or based on a multiple of invested capital. It is the fund's performance against a cohort of peer investments with the same vintage year, meaning the same year that the fund was funded. And the reason we do that is, let's just take a timeline, and let's say this is 2015, there's 2016, all the way to 2020. Well, it would be unfair to compare, and let's say we're in 2023 right now. Let's say we're all the way to 2023. It would be unfair to compare something in 2020 with something in 2015 in terms of performance, because you had a different economic environment in 2020 than you did in 2015. So the best way to compare investments is to say, well, every investment that was funded in 2015, let's rank those. And this way here, the fund itself, the investment fund, will be either a first quartile fund, a second quartile, third or fourth quartile fund for that particular vintage year. Same with 2016. You should compare them all in the same year that they were funded, because they all face the same economic environment. Real estate managers are evaluated by the cap rate being earned on properties. It's kind of like a cash yield. Let's say you buy an apartment building for $1 million. Well, what's my yield on that apartment building? So it's our net operating income divided by property value. Capital loss ratios. The capital loss ratio ranges from 0 to 1. It can't be less than 0, because if you don't lose anything, your numerator is 0. If you lose it all, your numerator is going to be your total invested capital. So your capital loss ratio will be your capital loss divided by the total invested capital, and it gives you sort of a probability of permanent impairment of an investment. So if a fund manager over time has, throughout a number of different funds, has had a capital loss ratio of 4%, then there's a 4% probability of permanent impairment of an investment. In terms of the total capital that you have, you can expect that 4% of it will be permanently impaired. Okay, let's look at some performance appraisal issues when it comes to hedge funds. Hedge funds, some strategies require leverage. So relative arbitrage is a good example. Market neutral is another good example that require an amount of leverage. So you're going to have a return series. And the return series will tell you how the portfolio did. And of course, there's leverage involved, so it will affect the return series. So when we're looking at returns of hedge funds, following strategies that typically use a lot of leverage, a more important question is not so much, well, what was your returns over a period of time, but rather, how were those returns achieved? That gets at the question of how much leverage are you actually using. So performance measures won't capture the use of leverage, but it may be critical to the strategy. So by asking the question, instead of saying, well, let's see what your performance was, but tell me how you achieved that performance. And if that performance comes with an amount of leverage, at least there you're aware of the level of leverage being used. That is part of the assessing the performance of that fund, is how was leverage used in achieving those returns. Illiquidity and potential redemptions. This is a tricky one. Hedge fund managers are motivated to show good performance. And you show good performance by having an increasing net asset value over time. However, redemptions are met at net asset value. So if you have illiquid positions and you're marking them to model to show a good increase in net asset value, and somebody says, well, I'd like a redemption right now. You've told me the net asset value. I know how much I'm going to get now. The answer from the fund manager would be, well, hang on a second. These are illiquid positions. That's a mark to model. If I were going to liquidate that position, the fund's NAV would not be what I just reported. So maybe the fund manager says our NAV is 100 million. But if I actually tried to liquidate the illiquid positions, our NAV would be 92 million. And if I own 10% of that fund, if I've invested in it and my money represents 10%, Do I get 10 million or do I get 9.2 million? You're reporting this is your NAV to show good performance, but then you're suddenly telling me, oh no, that's not really our NAV? Then shouldn't you be reporting this NAV? Well, if you did, you'd have lower performance by 8%, right? Redemptions have to be met at NAV, so NAV should reflect liquidation effects. But if it represents or reflects liquidation effects, then suddenly your performance doesn't look as good. How do we get around this little tricky issue? To understand that, let's look at level 1 to level 3 pricing. And it's really at level 3 where we have the issue. Level 1 asset pricing, we have exchange-traded, publicly available pricing. And level 2, we have broker quotes. That's just as good as publicly available information, because you call a broker, he'll tell you, I'm willing to buy at this price and sell at that price. Okay, we have a price in the market that we know we can liquidate at. So to value our long positions, we'll use the bid. And because to value our long positions, we would have to sell them if we were liquidating. If you sell on the bid. And to value our short positions, we would use the ask price for the short positions, because to cover your short positions, you have to buy. So we're going to use the lowest price for our long positions, the highest price for our short positions. That'll give us a very conservative NAV. So if you have level 1 or level 2 pricing, you can get to a very objective measure of NAV and of fund performance. Some managers will, if you have a bid and an ask, rather than value the long positions on the bid and the short positions on the ask, they'll all be valued in the midpoint between the bid and the ask, which still may not reflect NAV. If you have level 3 pricing, this is mark to model, because there is no market pricing that exists for long periods of time. You have illiquid holdings, you're going to use a mark to model method, which will not necessarily represent the net asset value if you tried to sell it. So funds will typically have 2 net asset values. One for performance, which will reflect mark to model pricing, and one for redemption, which will reflect liquidation pricing. So that if you were going to redeem, understand that there's a liquidity hit. Since we have no plans of selling anything, we're not going to report a liquidity NAV, we're going to report a mark-to-model NAV, because that's where we are. And if we hold it long enough, we can realize the price that we want. But if you force us to redeem your share and to sell and to liquidate, it's your redemption that's causing a lower NAV. So that's what you're going to get. So that's how they get around it. They report 2 NAVs, a performance NAV and a redemption NAV. Tail events. These are low probability, high severity events. Comes in line with using a lot of leverage, especially for things like market neutral. There is no guarantee that your short positions will go down and your long positions will go up, or that the spread between 2 mispriced securities will close. You could be in a situation where your long positions start dropping and your short positions start increasing, and you get hurt on both sides of the trade. So there's no guarantee that just because you have a strategy, it's going to work out for you, and leverage will magnify those losses. If you go back to the late 1990s and look up long-term capital management, that's exactly what happened to them. So for tail events, how do we assess the probability or the severity of these events? Stress testing. So if we're looking at appraisal performance for a hedge fund, we may ask, well, have you done any stress testing, and what are the results of those stress tests? What happens if interest rates move 300 basis points over the next year? What will that do? What happens if equity markets drop 20% over the next 6 months? What will that do? And scenario analysis. We just went through a pandemic, and we saw what happened to equity markets. They dropped very quickly, about 33% in a matter of 4 or 5 weeks. Well, what would happen to your fund, to the portfolio, if that event happened again? So you would run it through that particular scenario again. For hedge funds, redemptions tend to increase during times of poor performance. And when you have to meet a redemption when your fund is down, you have to crystallize those losses. There are lots of times where if the market is down and you're holding a portfolio, if you continue to hold, it tends to repair itself over time. You don't have to take those losses. But if you have to meet a redemption right when you're in the middle of a drawdown, then yeah, you're not going to get those losses back. Those losses become crystallized. Funds charge redemption fees or suspend redemptions during stress times so that they can avoid having to crystallize those losses, because those losses become losses for the other partners in the hedge fund partnership as well. Notice periods allow for orderly liquidation. So let's say that this is our year. Here's the end of this quarter, end of Q1, end of Q2. You may have up to a 60-day period where you have to give notice that you want your redemption at the end of Q1. And again, same here. You may have a 60-day notice to say, I want my redemption at the end of Q2. So I, as the fund manager, have 60 days notice of all the redemptions so I can follow a more orderly liquidation pattern as opposed to having to sell everything by the end of the day to meet an end-of-day redemption. Mutual funds have to do that by the end of the day. Lockup periods allow time for a strategy to work as well. So I may have a strategy that I know I'm going to be illiquid for the first year or the first 18 months. So if you're putting money into my fund and I'm putting more money to work and putting out new positions, I may lock you up for 12 months or 18 months saying you can't have your money back. And that's a hard lockup. We've already talked about a soft lockup is you can't have your money back, but if you really want it back, it's going to be at a 20% discount. Finally, last learning objective, LOSJ. Keywords here, calculate and interpret. The only calculate we have to do in this reading. Calculate and interpret returns of alternative investments on both before fee and an after fee basis. And we'll go through a number of examples in the reading, but we'll cover off some narration here first. Some custom fee arrangements, other than just the stated fee arrangements, we have other ones. Fees based on liquidity terms and asset size. So if an investor is willing to accept a longer lockup, they could probably negotiate a lower fee. If they're coming with a significant amount of money, a larger investment, they can negotiate a lower fee as well. Founders' shares, and this is not really shares that are given up, it's just a share of the partnership, right? Founders' shares. Entitle early investors to a lower fee structure. For example, the first 100 million of assets under management may only pay 50 basis points management fee instead of 1%. Or early investors get a lower fee once a certain level of asset under management is reached. So it may be 200 million or 100 million, and I'll start taking investors in. They'll pay the 1% until we hit a certain level of assets under management. Then their management fee will drop to 50 basis points, and anybody new after that will be at 1%. And there's something called either or fees. So it would be something like a 1% management fee or just 30% incentive above the hurdle, whichever is greater. And it's not based per year, it's ongoing. So let's say in a particular year, the 1% management fee is paid. It will reduce the 30% incentive fee for the next year. So if the next year, the 30% incentive fee ends up being 8 million and you paid 2 million on a management fee, then next year the incentive fee would be lowered by the 2 million to 6 million. Hedge fund databases and indexes will report performance net of fees. This is all the fees that the hedge fund pays. It's all the fees. However, every investor will have different fees. I shouldn't say every investor, but some of the investors in there will have different fees than the other ones. So fees can differ by investor, so each investor may realize a different return. So when we're looking at hedge fund returns net of fees, that does not necessarily mean we would experience that same return going forward or similar return pattern going forward, because the net of fees may represent fees that are lower than what we would have or potentially higher than what we might be able to negotiate. Let's walk through example 4, 5, and 6, because this is a calculate and interpret reading. We should walk through some calculations here. All right, example 4, incentive fees relative to waterfall types. A PE fund invests 15 million in a nascent luxury yacht manufacturer and 17 million in a new casino venture. The yacht manufacturer generates a $9 million profit when the company is acquired by a larger competitor, but the casino venture turns out to be a flop when its state licensing is eventually denied and it generates a $10 million loss. If the manager's carried interest incentive fee is 20% of the profits, what would this incentive be with a European-style waterfall whole-of-fund approach? And what would it be if the incentive is paid on an American-style waterfall deal-by-deal basis, assuming no clawback applies? So here we are. Our investment was 32 million because we had 15 million in the yacht and 17 million in the casino. So there's 32 million. We generated a $9 million profit on the luxury yacht manufacturer, but a $10 million loss on the casino. So we made 9 but lost 10. We lost 1 overall. So our investment was $32 million. Our profit or loss was negative $1 million. What is our total incentive? 0. We made nothing. Investors lost $1 million, so we get nothing. But if it's deal by deal, here's the yacht company, $15 million went in. We had a profit of $9 million, and if it's 20% carried, 20% of $9 million is $1.8 million. The casino venture lost money, so there's no incentive fee on this, and there's no clawback, so that 1.8 doesn't get clawed back. The hedge fund makes 1.8 million. Investors, instead of losing 1 million, now lose 2.8 million. So let's do some reading here. In aggregate, the fund lost money. So with a European-style whole-of-fund waterfall, and assuming the time period for the gain and losses are the same, there is no incentive fee. With an American-style waterfall, the GP could still earn 1.8 million on the yacht company, thereby further compounding the loss to the ultimate investor of negative 2.8 million net of fees. If the gain and loss in this example transpired sequentially over different years, perhaps with the yacht company gain occurring first and then the casino venture loss later on, the outcome for a European-style waterfall would typically result in initial accrued incentive fee for the yacht manufacturer gain. But if there is a clawback provision in place, and then there would be a clawback of that fee for the investor in subsequent year when the casino venture loss is eventually realized, still resulting in no overall incentive fee. Waterfall language and clawback provisions on fees are very important to study and understand in offering memorandums, and these terms can vary widely. All right, example 5. This one has 5 questions. It's pretty straightforward. AWJ Capital is a hedge fund with $100 million of initial investment capital. It charges a 2% management fee based on year-end assets under management. Be careful about this in any question you get. Typically, you would have beginning of year assets under management would be your management fee, but this is specifically saying it's year end. And a 20% incentive fee. In its first year, AWJ Capital has a 30% return. Assume management fees are calculated using end of period valuation, which we're already told up here based on year end assets under management. So we had 100 million, 30% return. We end with 130 million. Number 1, what are the fees earned by AWJ if the incentive and management fees are calculated independently? What is an investor's effective return given this fee structure? So we have 2 fees. We have a 2% management fee, and since it's assets under management at the end of the year, we have 130 million at the end of the year. It's 2% of the 130 million. And since we're told that the management fee and the incentive fee are calculated independently, the 20% is calculated on the 30% increase. We don't subtract the fees. So we made 30 million, 100 million to 130. So we get another 20% of the 30 million. So 2% of 130 million is 2.6 million, and 20% of 30 million is 6 million, for a total 8.6 million. That means the investors get 130 million minus the 8.6 million, which would be 121.4. Since they started with 100, that's a 21.4% return. Let's look at the numbers here. 130 million at 2%, 2.6 million, that's the management fee. The incentive fee is 130 minus the original 100, because it's only on the profit, right? Multiplied by 20% is 6 million. Add them together, you get 8.6. Take the 130 minus the original 100 that investors started with, minus the 8.6, divided by the 100, because that's what they started with. You get 21.4% return. Number 2, what are the fees earned by AWJ, assuming that the incentive fee is calculated from the return net of management fee? What is an investor's net return given this fee structure? Well, you would take the 2.6 million off the 30 million first, and then you'd calculate the 20%. So let's have a look at that one. So there's our 2% on the 130 million, 2.6 million, but then we're going to subtract the 2.6 here. 130 ending minus 100 beginning minus the 2.6 times the 20% is 5.48 million. Add the two together, you get 8.08 million. Take your 30 million, 130 minus 100, take your 30 million here, minus the 8.08, and that'll give you 21.92%. Number 3, if the fee structure specifies a hurdle rate of 5% and the incentive fee is based on returns in excess of the hurdle rate, what are the fees earned by AWJ, assuming the performance fee is calculated net of the management fee? What is an investor's net return given this fee structure? Well, we're still going to have the same management fee on end of year assets under management, 2.6 million. We'll take the 30 million minus the 2.6 million minus another 5 million. Why are we subtracting another 5 million? The hurdle rate is 5%. We started the year with 100 million. So 30 million minus 2.6 minus 5, and then we get 20% of that. So let's have a look here. Same management fee. Here's our 130 minus 100. Minus the 5. The 5 million is our hurdle rate. Minus the 2.6, which is the management fee up here. Then we multiply that by 20% to get 4.48 million. Add the two together. Fees are 7.08 million. So it's 30 million minus the 7.08 million divided by the 100. You'll get 22.92%. Notice what's going on. The investors receive 21.4% when calculated independently and no hurdle rate. They received 21.92 when the incentive fee was net of the management fee, so they end up with a higher return. And when you throw a hurdle rate in, they move from 21.92 to 22.92%. Number 4, in the second year, the fund value declines to 110 million. The fee structure is as specified for question 1. But it also includes the use of a high watermark, computed net of fees. And what was the high watermark computed net of fees? In number 1, what was the net asset value after all fees were done? Remember, it was 121.4 million, right? What are the fees earned by AWJ in the second year? What is an investor's net return for the second year given this fee structure? Well, we're ending at 110. We're under the high watermark. There'll be no incentive fee. So this is super, super simple. It's 2% of assets under management at the end of the year. We have 110, so it's 2% of the 110. Number 4, 110 million times the 2%, 2.2 million management fee. No incentive fee because the fund value has declined in value. Total fees to AWJ Capital, 2.2 million. The investor return, there's the 110 that we ended with, minus the 2.2, minus what we began with, the 121. Divided by what we began with, we should have a negative return. We do, negative 11.2%. Beginning capital position in the second year for the investors is, remember we had the 130 from question 1 minus the 8.6 fees, 121.4. The ending capital position at the end of the second year is 107.8 million because it's 110 minus the 2.2. Question number 5, in the third year, the fund value increases to 128 million. The fee structure is as specified in question 1 and 4. What are the fees earned by AWJ in the third year? What is an investor's net return for the third year given this fee structure? Management fee, super, super simple, 2%. 2% of 128. Then, remember, they're calculated independently, right? What's our high water mark? 121.4. So we'll take the 128 minus the 121.4. That's the excess. We get 20% of that. Let's see, number 5, 128 times 2%. 2.56 million for the management fee. There's the 128 minus our high watermark, 121.4, because we can only earn an incentive fee above the high watermark. And we get 20% of the difference between 128 and 121.4. That's 1.32 million. So we add the 2.56 and the 1.32. There it is right there. We get 3.88 million. Investor return, we ended the year at 128. Minus the 3.88, and we began the year at 107.8. Remember in the previous question, what did we end the year at? We ended the year at 107.8. So if we want to know the return in that year, that is our beginning assets, 107.8. So 128 minus 3.88 minus 107.8 divided by our beginning amount, 15.14% for that year. Okay, finally, example 6, comparison of returns. Investment directly into a hedge fund or through a fund of hedge funds. An investor is contemplating investing 100 million euro in either the ABC hedge fund or the XYZ fund of funds. XYZ fund of funds has a 1 in 10 fee structure and invests 10% of his assets under management in ABC hedge fund. ABC hedge fund has a standard 2 in 20 fee structure with no hurdle rate. Management fees are calculated on an annual basis on assets under management at the beginning of the year. For simplicity, assume that the management fees and incentive fees are calculated independently. ABC Hedge Fund has a 20% return for the year before management and incentive fees. And you were contemplating a €100 million investment in either ABC or XYZ. Calculate the return to the investor from investing directly in ABC Hedge Fund. ABC has a 2 and 20, and they had a 20% return on $100 million. So they made $20 million. And the management fee is on beginning of year assets. So it's 2% of the $100 million. That'll be $2 million. And the incentive fee is 20% of the return. The return was $20 million. 20% of $20 million is $4 million. So $2 million on the management fee, $4 million on incentive fee is $6 million off the 20. The investor would have a 14% return. ABC Hedge Fund had a profit before fees on a $100 million investment of $20 million. The management fee is $2 million. That's $100 million times the 2%. And the incentive fee is $4 million. The $20 million return at 20%. The return to the investor is 14%. The $20 million minus the management fee minus the incentive fee leaves $14 million on a beginning balance of $100 million. That's 14%. Calculate the return to the investor from investing in XYZ fund of funds. Assume that the other investments in the XYZ fund of funds portfolio generate the same return before management fee as those of ABC Hedge Fund, and that XYZ fund of funds has the same fee structure as ABC Hedge Fund. So remember, we said that 10% XYZ fund of funds invests only 10% into ABC. So of the $100 million going into XYZ, $10 million goes into ABC. But for simplicity, they're saying, listen, imagine that all the other funds have the exact same return. Let's just, make it nice and simple. What's going to happen? Well, we would calculate ABC's net to XYZ the same way we did in question 1. If the investor invests directly in ABC, they have a 14% return. If XYZ invests in ABC, they have a 14% return. So XYZ will have $14 million return. They charge a 1 in 10. And it's 1% on beginning of year assets. So beginning of year assets was $100 million. There's $1 million there. And it's 10% of the $14 million, which is another $1.4 million. So another $2.4 million in fees would disappear. XYZ Fund of Funds earns a 14% return or $14 million profit after fees on $100 million invested with hedge funds. The XYZ Fund of Funds charges the investor a management fee of $1 million in the beginning of year assets and an incentive fee of $1.4 million, which is the 10% of the $14 million they made, or at least that they got from the funds that made it. The return to the investor is 11.6%. The $14 million minus the 1 minus the 1.4, 11.6%. And 3 is, why would the investor choose to invest in a fund of funds instead of a hedge fund, given the effect of the double fee demonstrated in the answers to question 1 and 2? And we've been through all of the advantages of using a fund of funds. They will carry out due diligence on the hedge funds. They can negotiate better redemption terms, slower or shorter lockup periods, and maybe even slightly lower fees. Here in this question, it would have been a better question if the XYZ fund of funds didn't pay the same fee structure as the investor did. So instead of a 2 and 20, maybe they had a 1.5 and a 15. That would have made it a more interesting question. And it would have proven a point, or at least displayed a point, that the fund of funds can get lower fees. That's why you would do it. In this case, why would you do it, right? The scenario assumes that the returns are the same for all the underlying hedge funds. In practice, this result will not likely be the case. An XYZ fund of funds may provide due diligence expertise and potentially valuable diversification. And it doesn't say anything about negotiating lower fees. Typically, you would expect to see that the fund of funds would have lower fees. A fund of funds is what's called a feeder fund. And a feeder fund can go to a bunch of hedge funds and say, listen, we can send you a lot of assets under management, but we want lower fees and better redemption terms. Again, this example used the same 2 and 20. Typically, if XYZ is paying 2 and 20 and you would pay 2 and 20, there really is no reason for XYZ other than due diligence. But is due diligence worth $1.4 million? I don't think so. Well, actually, 2.4 million, right? 1% plus the 10% return. I'm sure you could hire a consultant for 150,000 to find you a good bunch of hedge funds to invest in, to do the due diligence for you. I don't know, maybe even cheaper than that. I'm just throwing out a number that's much cheaper than $2.4 million, right? Anyways, that wraps it up.